So the next standard we are dealing with here is IFRS 15, which is called revenue from contracts with customers. It's a very interesting one. From contracts with customers. All right, how do we go around it? Now, I've developed a simple acronym and a short way of understanding it. First of all, what is revenue? Revenue is something you get in your ordinary course of activity, all right? The ordinary course of activity. You see, you need to understand the difference between revenue, incomes, and gains. What you get in what you normally do is the one that we call what? Revenue. So if I sell phones, the money that I get from trading the phones is what we call what? Revenue. Good. How do we recognize revenue? When do we need to recognize revenue? That is where I've developed a simple acronym for you. We call it what? Copa. 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 Before you can recognize anything revenue, it must qualify the Copa. What is Copa? C means that there has to be a contract. All right, there has to be a contract. Now, the standard says that you need to first identify the contract. What is a contract? A contract is an agreement between two parties that creates what? Rights and responsibility. That's the key thing. Right and obligation. In every contract, you have your rights, and in every contract, there is an obligation. So if the contract doesn't actually spells out the rights and the obligation, there is no contract. If I'm selling something to you, Adjoa Mansa, my obligation is to give you the thing, deliver it to you. All right. My right, therefore, is to claim money from you. All right, to collect money from you. So in every contract, you need to identify the right and obligation. The key is that the standard says that you don't need to have the contract written down. You don't need to write it. The contract needs not to be written. It can be constructive. The fact that I always sell to you, Debia, means that you are my customer. There is a contract of sale because the Toma we are invoice. An invoice in itself is a contract. And for every contract to be valid, I mean, there are 4 things you need to look out for in the contract. Number 1 is that the parties have approved the contract and their rights have been identified. So there has to be approval. All right. The people involved in the contract of selling or sale must approve it. You cannot tell me, you see, you know how it feels like when you think you've bought something genuine and you go there and it's fake. Do you know how it feels like when yesterday the referees and the VAR decided to treat Liverpool the way they treated us? It's very sad. And nobody approves those kind of things. So, but I mean, there has to be an agreement. An agreement has to be agreed. That is what we mean by what? Approval. Not only that, to say you have a contract, the payment terms must be identified. Payment terms. The payment terms. How is payment to be done? All right. When you give somebody an invoice, the invoice should state your payment model. It should state your payment model. If you don't put in the payment model, you are actually not done anything. All right. Then the contract should also have a commercial substance. What do we mean? If it is breached, it should be capable of you being taken to court. Commercial substance. Then the last part is, and that is the most important part, is that there has to be a probability that the entity will be paid. Highly probable that the entity will be paid. And so now I record what Pienhokra say, you will be recording the revenue. Why? Because if you sell to somebody and the person goes bankrupt, will you record the revenue? Because if you record the revenue, you will not be getting the money. So who are you deceiving? All right. if we make it like that, then anybody can put any figure in his financial statement. Who did you sell to? Mad people. Because you cannot go to the mad people to actually prove that you sold the thing, the figure will be in your financial statement. And it's a problem. And so to be able to record revenue, there has to be a high probability that you'll be paid. Now, let's look at this illustration that I've given you. Gideon Bona has a year end of 31st December 2011. On September 2011, Gideon Bona signed a contract with the customer to provide them with what? An asset on 31st December 2011. Control over the asset is passed to the customer on 31st December 2011. The customer will pay 1 million the next year, June. By 31st December, as a result of changes in economic climate, if Gideon Bona did not believe that it is probable that he will collect the consideration he is entitled to, he cannot and should not record revenue, because this one is in danger. If you know you will not collect the money, then you can't record the revenue. Please, is it made clear? Is it okay? Any question on that? Any question on that? I take it that you understand. So we come to step 2. O means performance obligation. So there has to be performance obligation. In every contract, in every revenue contract, there has to be something somebody is doing. Performance obligation. All right, performance obligation is very, very important. So the performance obligation can be a distinct obligation or a combined obligation. What we mean is that in the contract, there may be 2 or more obligations in one. A typical example, here we don't see that much, but in your exam, that is what they do. A typical example is where you are selling to somebody, and the thing you are selling comprise of the goods itself, and at the same time, after sale what? Maintenance. So you see that in between the two, you will have 2 obligations. One is the sale of the goods, the transfer. The other one is the maintenance. Another one is that selling through a principal or an agent. You see, if you are the principal, your revenue that you get is actually the money that you are supposed to receive after paying the agent's commission. True or false? True or false?
True.
All right. If you are the agent, the money that you get is not your money. Your revenue is the commission that you will be paid by the principal. So that is the principal and the agent concept. But the idea about performance obligation is that, watch out in the question, there may be more than one obligation in the sales contract. All right. So always watch out for that. So normally you see warranties, right? Will be better at the amount, so no amount of warranty. So in case you see anything like that, so I've said that most of the time, the warranty is an assurance that the product will function as intended. So if it doesn't function as intended, then it means you will be having a liability. And that liability, if that is the case, the warranty should be accounted for under what? IAS 37. All right. So check if there is a probability that you have a present obligation. If there is a probability that you have a present obligation, so that what on Adena man call for, but it will you professional advice tells you that the thing will not function as it intended, and you also gave a warranty, then it means you have a present obligation. All right, you have an obligation. So check if there is an obligation for you to recognize a liability. Now look at this illustration. Look at this illustration that I've done here. Eliwachi is a company that is into computer business and primarily really sells computer hardware, as well as selling computers. It also supplies and installs software on the computers. You know, people do that. When you buy the computer, they will give you Microsoft. They will install it for you. Now, and provides other technical support packages over a number of years. So you see that one business, he sells her hardware, he sells software and provides technical services. So you see the obligations are many. The obligations are many. So you need to split the obligations and report on them individually, because the goods there is instant. The person can take it for you to be able to recognize this. So what if the maintenance here is a 3-year maintenance? What I'm saying is that, so I want you to give me your opinion. Let me see who can guess this. I'm selling something, and that is P, price, transaction price. All right. The price of the thing is 1,000 cedis. Inside the 1,000 cedis is the good itself, the obligation, and it is 800. Then maintenance is included in the price. A 2-year maintenance is included in the price for 200 cedis. So that is the composition of the. Now, I sold this good to the person on 01/2022. By the end of the year, 31st December 2022, they brought it for repairs. So I did maintenance. Who can tell me how much my revenue will be in the year 2022? Yes, who can tell me? Yes, who can tell me?
It will be 1,000.
It will be 1,000. Okay, so is that Joseph?
Yes, sir.
All right, who else?
Because they sold the goods, the price is 800. And they bought for maintenance. So maintenance too is 200.
So it's 1,000.
Whether is for the maintenance is for 2 years. So maybe you have to pro rata 100 per year.
But if you pro rata 100 per year, you gave me 1,000. So why are you giving him 100?
And I'll change my mind to 900.
Why? So you see, your revenue.
I didn't see the 2 years.
That is what your exams is about. So after you've left the exams room, you now come back and say, somebody is saying 500. I wish you can give me the explanation to your 500. You see, the good is the good. The person has received it. But the maintenance is 2 years. So you need to prorate it. And you've done only maintenance for 1 year. So your revenue will be 900. So have you seen the trick? These are the things. So
that's why they beat me.
So that is what your exams is about anyway. That's why I'm taking my time to let you know, because we are building on it, and you will see that, oh, okay, so this is what they've been doing to us. Oh, okay, so that is that. So that's the transaction price. So that is just an aspect of the transaction price. The other aspect of the transaction price, we have 4 areas of the transaction price. Number 1 is variable consideration. How do we deal with variable consideration? What is a variable consideration? A variable consideration is an additional consideration that you will be receiving as part of your consideration if something, you stand the chance of doing something extra. So if you know that you can do that thing, the extra thing, then the variable consideration will be part of your revenue. If you know you cannot do it, then don't record it. You see, in your SS level, when you were learning revenue, there was something called return inwards. If you remember, sales return inwards. We used to deduct it from the sales and get what we call net sales. So that is the kind of idea we are trying to communicate here. There's something called variable consideration. A variable consideration is an additional estimated amount that the entity will be entitled to if they are able to achieve something. So the thing is that whenever you are recording revenue, IFRS 15 says that the revenue that you are recording, make sure there will be no highly probability that you'll be doing a significant reversal of the revenue. And so now I record. Now let me explain the variable consideration to you using this illustration 5. Look at this. Ben Sam provides service to a customer for the next 12 months. The consideration is 12 million. So in actual sense, your revenue is 12 million. Ben Sam is entitled to extra 3 million if after 12 months, the number of mistakes fall below a certain threshold. So in this case, if Ben Sam is experienced enough to know that, oh, the sale will go above, you see, it says that the mistake will go, if the question says that after 12 months, if the number of mistake will fall below a threshold, he will have an extra 3 million. So if Ben Sam has a professional judgment to know that the mistakes will actually fall, then Ben Sam should add that extra 3 million to his revenue to make it 15. But if he knows that he cannot make the mistake fall below that threshold, then the 3 million won't come into the equation at all. Please, do you understand it now? Class, do you understand it now?
Yes, sir.
All right. So you see, then the detail is that, okay, discuss the accounting treatment for the year 2011. If Ben Sam has experience of providing identical services, and it is highly probable that the number of mistakes will fall below the threshold. If it will fall below the threshold, then it means that he can add the 3 million to the 12 million and record revenue of what? 15. But if he knows that he can't meet that target, he can only record his 12 million. Yes, I think somebody was calling me to ask a question. Did I hear somebody trying to ask a question? All right, so that is variable consideration for you. That is variable consideration. The next thing you need to know about the transaction price is what we call significant financing component. Significant financing component. Guys, take IFRS 15 serious. I know what I'm saying. And what I'm doing serious. Take it serious. All right. Because I'm tipping IFRS 15 and IFRS 9 financial instrument for your sitting now mobile bearing. All right. How do you do the, you can write it down. Can write what I said down.
Third one, third standard.
I mentioned only two. You want an extra one?
Yes, sir.
It will come. Don't worry. It will come. Now, what do we mean by financing component? Now, let me give you this simple illustration. I'm selling something to A and I'm selling the same thing to B. All right. But for A, I'll be collecting cash. And for B, it is on credit basis. I now charge this guy 100 cedis and charge this guy 150 cedis. What can you tell me? The same product. You know, people do it to us in the market a lot. What can you tell me? Why do you think I'll sell to A at 100, but B, I'll sell it to him at 150? Yes. What can you tell me?
Because you are selling to him on credit, the B.
Yeah, it's true. It's because I'm selling to him on credit. But you see, that one is just the obvious interpretation. But the real meaning is that when I sell to this person, I collect my money straight away. Meaning will be any problem. But this guy will be keeping my 100 cedis for a while. So in a way, and therefore he is paying an interest on it of 50. Are you getting the picture? You see, Ghana makes these things hard to understand because of the word mepacho. Oh, mepacho. In elsewhere where we brag that, oh, bibiania yes, we will call abroche ntesa, abroche mepacho nye juma wo. Yeah, here when policeman catch you, what do? You say, oh, Charlie. When you get there, will you do me Charlie? Yachiwa. So you see, what you are seeing here is that the thing is 100,000. So it tells you that there is a financing component in the credit facility, i.e., 100,000, and the 50 you are paying is an interest because you bought the thing on credit. All right. So that is something you need to understand. That is what we call significant financing component. So let me give you this illustration for you to understand it the more when it comes to the significant financing component. Now, watch this. Watch this. This illustration. You see, the component will be coming in because of the length of time, because the other one is on credit. So cash sales, you won't have that. But you see, and I've put this thing here. If there is a financing component, then the consideration receivable needs to be what? Discounted using what? The rate of borrowing to who? To who? Please, to who? What do you see there? To who? The rate of borrowing at which the customer borrows money. Do you see that?
Yes, sir.
See, in your exams, he will bring the situation to you, but he will give you two rates. The rate at which the supplier borrows money and the rate at which the customer borrows money. Please, which one are you supposed to use? The rate at which the customer what? Borrows money. So you see, if you want to record this revenue that we have here, the question will give you a discount factor. So you will use the discount factor to PV the money, because the money is in future. You have to PV it. So when you PV it, the discount factor you are using is the one we are saying that is the rate at which the customer will borrow money. I'm going to do something to you very soon, and I will see if you remember, because we did that thing the first day we started this class. I'm going to do it again after in this thing we are doing. All right. So now look at this illustration. Ruby enters into a contract to sell an equipment. Control over the equipment is transferred on that date. The price of, so when you see this statement is trying to tell you that performance obligation is completed, and you see that is the last thing. This one, you recognize revenue when the obligation is performed. So if the obligation is not performed, please, you cannot recognize revenue. I'm repeating. If the obligation is not performed, you cannot record revenue. And this is the basis of your exams that I'm saying be careful. All right. Now, so now he has transferred, which means the price of the thing is stated in the contract is 1 million, and it is due in what? December 2013. When was the sale done and the transfer done? The obligation done. This is the date. Because the contract says control over the equipment to the customer is what? Transferred on that date, and this is the date. But the revenue will be received when? 2013. So 2011, 2013 is how many years? 2 years, right? 2 years. So it means that the person is what? Actually borrowing that 1 million. And so there is a discount factor you need to do. And I said that when there is a length of time, what do? You discount. You discount. So now you have to discount using 10%. 10% for 2 years. How do you do discount factor? How do you PV? I've given you the formula before time and time again. So it's 1 over what? 1 plus R raised to the power what? N. So 1 over the 1 rate is 10. So 1 raised to the power how many years? 2 years. So please, ladies and gentlemen, what will you get? What will you get? Punch calculator and give me the value. So once you
0.826.
0.826. So this is the discount factor. You now multiply it by the 1 million in the question. So you should be getting like 826,000.
446.
It's what?
826 446.
826 446. So 1 million has now turned into what? 826. So this is the value of the revenue that you'll be recording. Within the 2 years, there is something you need to recognize, which we call the subsequent measurement. Who can tell me that thing, what that thing is?
Unwinding discount.
Winding discount. Charlie, God bless you. You are just telling me that you've been listening to lectures on winding discount. So the unwinding, how will we do the unwinding? it will be 10% on this one for the first year. All right. 10%. Now, I'm going to see if you people remember when we did the unwinding. So if the first year is 10%, so now we have 2011, 2012, and 2013. The value as at 2013 is 1 million. The value as at 2011, we had 826,446. So unwinding. What is 10% on this? It will be
82644.
82644.
45.
44,
Yeah.
6 or 45. Yeah. 0.65.
Yeah. 645. Yeah.
Yeah, or 645.
Yeah.
So that is what you have. So now that is your unwinding. Since this one is revenue, we call it unwinding finance gain because it's revenue. If it were to be a liability, we will use it at what? Unwinding finance costs. All right. So that is that. So if you now add that unwinding to this figure, what will you get for your 2012?
It will be 909,090.
090. So you see that if you do 10% again for the unwinding in this year, you get the 1 million. And you add, you get 1 million. So that is how you do it. All right. So that is how you find out significant financing components. So that is how you treat it. All right. So make sure you get the finance gain out of it. PV the thing and get the finance gain. All right. So that is that. That is that. Another thing under the same price, another issue under the price is what we call a non-cash consideration. A non-cash consideration. Please, if there is a non-cash consideration, this is accounting. We need the cash to record. So look at the fair value of the non-cash part and use the fair value. So look at the fair value and multiply the thing by the fair value. So non-cash consideration is measured at what? Fair value. So you look at the fair value and use it. All right. Now, Dave sells to Steve. Who's to
Adam.
please mute, I beg. Oh. James sells to Steve. Control is transferred in January 2011. Consideration received by Dave is 100,000 shares. And this is what you do when we are doing share-based payment. Shares in Steve with a fair value of 4. As at 31st December, the share price has now gone to 5. So what are you going to do? You are going to recognize using the fair value at the date of the transaction. And what is the shares value at the date of the transaction? Yes.
4 cedis.
4 cedis. So that is what you use to value. So ignore the 5 cedis. All right. You use the consideration at the fair value at the date. All right. The obligation was fulfilled. All right. So that is that. That is that. Okay. Now, the most important, so we've done non-cash consideration. Now, the most tricky one. The most tricky one is discounts. It's interesting, it's discount. And I'm going to explain to you how the discounts operate. They won't tell you the the supplier gives discount. No, they won't do that. At this level, they won't do that. What they will do is this, and I want to use this as an illustration for you. Imagine I've taught you that a transaction price may be split into 2. Okay. So we did an example where there was 1,000 cedis, but the component of this one was the goods itself. You remember? And I said it was 800. And I said the maintenance component is what? 200 for 2 years. So we did that, and I think Joseph realized that, oh, if the time that you fulfill the maintenance, you prorate it, and it can even be monthly. But in the example I gave you is 2 years. So he said that, and that was rightly so. But what if I tell you that the good is 800? but I don't know the maintenance. I don't know the maintenance. Your automatic response is that the maintenance will be 200. That's your automatic response. Because if the thing is 1,000 and the goods alone is 800, then my automatic response is that the balance is the maintenance. But what if I told you that the guy does maintenance, all right, for let's say 180 at a cost. He does it cost with a markup of 50%. How much do you think my maintenance will be? How much will my maintenance be?
270.
270. Now, if it is 270, if I add this one and this one, what will be it will be 1,070, right?
Yes.
Is it not higher than this? Is it not higher?
Yes,
It's higher.
it is.
But the person is selling the thing together at 1,000. What does that tell you?
A reduction of 70 cedis.
A reduction of 70 cedis. It means that the person has been selling the thing at a discount of 70 cedis. My question to you is that discount of 70 cedis, is it coming from the maintenance or is coming from the good? Any idea?
Maintenance.
Okay, maintenance. That is the obvious conclusion, but that is not right. Because when the person sold the thing to the customer, he didn't split it. He sold it to him at 1,000. And the discount we've realized is that, at the 1,000, what check customer no cross 70. But as to the 70, is it on the maintenance or is on the goods? We don't know. We found out that he gives discounts of 70%. So you cannot attribute it to just one of them. You have to attribute the discount to both of them. How do you do that? So now, what we are going to realize is that it is now going to be this 70 all over 170 to find out the discount in terms of percentage. So what is the discount percentage in here? What is the discount percentage?
6.5.
6.
4.
So let's say 6.5. Let's maintain it at 6.5%. Or better still, let's round it up to say 7%. Okay. So it tells you that anytime this man sells, he gives a discount of what? 7%. That 7%, you do the discount on this one and also do the discount on this one. So you share the discount among them both. So it tells you that this one will be multiplied by what? 0.93, right? And this one too by what? 0.93. When you do that, this side will give us how much? Do you understand why I've used 0.93?
744, yeah, 7%.
744. And here will be what?
Okay. That one would be
251.
251.
251.
Yeah.
251 doesn't serve our purpose. So.
But that's what we are getting.
Well, 270 by 0.93.
Yeah.
It doesn't really serve our purpose, but every fun is because of approximations, maybe. So when you add the two together, I wanted something
995.
995.
995. There is 5 short. So I will use a different illustration to do it so that it will be fixed. We should be getting 1,000 exactly. All right. So that it's because of the approximations that we did. That's why.
Well, let's do the 6.5. The 6.5 will
don't worry, I'll give you a proper example for that. So the that tells you that you need to split the discount for them. Let's use this example that I have here. So this is it. Steve sells a machine. He sells it at 100,000. The sale of the machine, so he says that he sells a machine and a 1 year free technical support service. The sale of the machine and the provision of the technical support service can be identified as what? A separate performance obligation. Steve usually sells the machine at 95. So the machine alone is what? 95. Standalone, 95. But it has not yet priced the technical support for the machine as a standalone product. Other support services offered by Steve has a markup of 50%. It is expected that the technical support will cost Steve what? 20,000. So that is the cost. So the cost is 20 and the markup is 50%. So yeah, technical support on the everything. I think it will be 30,000, right?
30,000. Yes.
It will be 30,000, right?
Yeah.
So you realize that when you now see this, the price of the thing becomes 125, meaning that the guy has been given a discount of what? 25,000. So what is the discount percentage? So we will do the extra 25,000 all over the 125,000 to get the percentage. What will be the percentage?
20%.
20%. So it tells you that he gives a discount of 20%. So we will now apply the discount 20%. So how we will multiply it by 0.8. This one too by what? 0.8. So when you do that, how much will you get here?
76,000.
76,000.
76,000. Then this one will be what? Should be like 24, right?
Yes.
It's 24, right?
Yes, 24,000.
Yeah. So that this one and this one is the meaning of the 100,000. So if you are they say how much, you see, and the thing is that, do you remember we did an example where the support service was for 2 years? So if this
Yes, sir.
support service is for 3 years or 2 years or whatever years, you now have to prorate it depending on the part that has been done. So you record the part that has been done. So he says that how much should the transaction price, how much of the transaction price should be allocated to the machine and how much should be allocated to the technical support. So we have 76 here and what? 24. So that is what we mean. Discount. All right, discount. So that is the solution you have here. So that is what we meant by step 4. Step 4. This thing we've done is actually about, helps you to understand step 4. Step 4 is allocating the transaction price the obligation. So that is what we've done. We've allocated Obianene there. Step 5 is the most critical of it all. It says that recognize revenue when or as entity satisfy what? The performance obligation. So if you have not satisfied the obligation, please, in your norm, if you have not satisfied the obligation, do not record the revenue. I beg you. This is the exams. All right. So let me give you this example, and that is the first part of IFRS 15. That is it. That is it. Now, let me give you this example. Let me see if you have understood what we are doing. A goes into contract with B. The contract is that A will deliver a car to B at a cost of 100,000. Once he receives it, B will now pay A, right? How much? 100,000. Now, B has not received the car, but has paid A the 100,000. What can you tell me in this case? Who can tell me? anything. You have not done the obligation, but you have received the money. And the question will say, A has recorded, yes, Maxwell. A has recorded 100,000
Advance payment.
as revenue. You say it's what?
It's a advance or deferred because you have not received the item you have paid, so it's like advance payment.
An advance payment. Okay. That is a statement from a Ghanaian. Yeah, that is what we call it. That is what we call it. But it's not really an advance payment. It's an advance payment, yes, I understand. But the meaning is that B has given A loan. Do you know that? And A has a present obligation. What is the obligation? To either deliver the car or refund the money. So it is not just an advance payment, it is a loan. In your exams, all that the examiner needs to do is that A rate of borrowing fund of interest is 10%. You see, I'm building a question. So, first of all, you need to understand that because A has not delivered the thing, the money is a loan. And because he has taken a loan, he has to pay interest rate. Do you remember we said that the person who received the thing, you use the interest rate of the person?
Yes.
Yes. So it means A has borrowed money, 100,000, and has to pay the interest. So you record, instead of saying, so you see, if you say advance payment, your entries will be different. But it's a loan. So you record a liability. So you will debit your cash. What is Cano? 100,000. You won't record sales credit. You will rather record what? Liability of how much? 100,000. Now, because you have still not delivered at the end of the year and your borrowing rate is 10%, you need to go ahead and continue to record an interest. So you would debit P&L interest of 10,000, which is the 10%, and credit your liability again with an additional 10,000. Have you seen how this thing is tricky now? Have you seen it now? This is what they've been doing to you people in the exam. And you people have not been seeing. Because all you know is that it will be an advance payment. That is what the examiner has been doing to you people. Most of you have not been seeing it. And the first day we started this class, we did this illustration. That is what the examiner has been doing to you. So that ends the first part of our revenue. The second part, it will be revenue from construction contract. I will do that one quickly. But before I go to that one, I just want to show you something. Yes, please.
Please, this interest that you have calculated, is that interest payable? Because what if maybe when you are in case you want to refund the money, since that interest portion is not explicitly stated in the contract, you might not pay it. You might just refund the 100,000.
That's a Ghana man business transaction you are doing.
Okay.
You have spoken like a Ghanaian. But you see, the people who develop the standards for us are not Ghanaians. You know that. They develop the standards as if we are there with them. And do you know why they brought all these things to Ghana? Because they want to come and do investment in Ghana. So the way you've said it, that is what you've been practicing in Ghana. So I don't know. But like I said, me patrono So that is how we operate. You think when you go abroad, let me ask you this question. In Ghana, the police in Chihuahua. These days, almost the cheat neighbor. Police in Chihuahua, you have like elsewhere, you have like 24 hours or 48 hours to go and pay the money that they give you. If you fail to pay, you pay the interest on the money. But like you have spoken, I mean, like you have said, a Ghana man, Obeko police station, time and up on Obeko could the same amount. Yeah. Unfortunately, these are the people who develop the standard for us. That is why I don't know if you listen to the news, this bank thing that happened. And is it what is the name of the person? Atoforsin. Was it Atoforsin Capital Bank? Yeah. People were bashing the Atuasian, yes. People were bashing the Attorney General that the money he collected back, he didn't take interest. When the money has been with the persons, he didn't take interest. And the explanation that they gave is that, you see, the Attorney General is a lawyer. What is his business with finance cost? He doesn't even know what it is. So for as far as he's concerned, Atuasian destroys some money, he has collected the money back. He doesn't know, the Attorney General doesn't understand what you mean by time value of money. He needs a professional to advise on that. So that is that. So please, it's an interest that is payable. As far as accounting is concerned, you need to include it in your analysis.
So, Sir Tom,
Yes, please.
Please, the one that we just illustrated, the last one, is there any unwinding interest in that one too?
No, you didn't PV any money. Have you PV'd any money?
Oh, okay.
You've not done a PV on any money. Unwinding comes in when there is a PV.
Okay. All right. And Sir Tom, let me ask this. Today, this one was just baffling my mind. You know, the fuel stations like Go and Total who give Tom's card and then the coupons. If customers go and buy the coupons, do they recognize revenue at that time whilst the customer hasn't gone for the fuel?
All right. So, yeah, I like that question. I really like that. So it's good. We say recognize revenue when obligation is what?
Performed.
Obligation is performed. Have they performed the obligation?
No.
Exactly. You see,
So
I've worked in a BDC before, and I've worked in an OMC.
Okay.
All right. Do you know how we record revenue? There is the station's manager's report, which shows the latest that have left the tank. All right. And we know the price per liter. That is how we record our revenue.
Oh, okay.
So you cannot tell me you have a revenue when you have not sold a liter. What is revenue? What you get in your ordinary course of activity. I've not done the activity, so how do I get a revenue?
Oh, okay.
Yeah. I've been a manager, a supervisor in an OMC before, and I've worked as a finance analyst before.
Wow.
Yeah. So
Okay.
so I've worked with Sahara Group before. Yeah. So energy, petroleum warehousing and supplies. I've worked in aviation, I've worked with them before for like 3 years.
Oh, that's
So
a very good experience.
Yeah. So if you have not done the obligation, you cannot record the revenue. So if your accountant is doing that, then there's a problem. Then he's not preparing account according to IFRS. Yeah. All right. Because you don't use coupon to record revenue. You use you use the latest that have left the tank to record revenue. All right.
Okay.
So that is that. So I was trying to tell you that these are how they ask your questions in the exams. I mean, if you check your past questions, that is how they've been doing the exams for you. There are so many examples there, but I wanted to show you one, but I think we will come to the past questions. So let me just skip that one. All right. But if you read this one, you will see what we are talking about. Tieku imports. All right. It is the policy of the company to make payments 1 year before delivery. Tieku does not offer discount for advance payment. The advance payment allows Tieku to manage import levels and communicate delivery to the customer. And on April 2021, Tieku received 5 million from the customer to supply a customized equipment. This is the date too. And on 31st, Tieku delivered the equipment. Tieku incremental borrowing rate is 10%. And the amount say is the same. This question that I've given you. The I am what you mean. And one for 5 marks. And one. See, so instead of making it this simple, I know a whole story before you run every so you have to apply the same thing we just did here. So it means that the 5 million he received without supplying the thing is a loan. So instead of recognizing revenue, that thing will not be a revenue. It's a loan. And the fact that the thing is delivered 1 year later at the end, meaning that they've given you this 10% to calculate the interest for the person. In the way, this is August 2022. Way. And one you. And one. That is why they have been killing you in the exams with near the 5 marks actually. Now drink a DM crane. It will be yen the same, may define and one and you know. All right. So you thought I'm just giving you a simple illustration. So somebody will go and meet this thing in the exams and will feel like Adiwe and trying you. Then somebody to maybe omunya upon here them. Oh, I say, oh, we had the question. We did it in class. There's no difference between these two. Yeah. So guys, everything we are doing, take keen attention. It's very, very important. All right. Now, let's go back and do the B part of revenue. And I think our time is even gone, so that I can drop it for now. Yes, and so we will continue. It depends on you. The B part of construction revenue is from construction contract. Now, for every construction contract question, guys, there are 4-step approach you need to adapt, and I've developed that thing for you in your manual for you to get it easily. Now, the first part of it is to do step 1, calculate what? The overall P&L. How do you do overall P&L? It's a contract. I mean, or construction firms. This is how you recognize your revenue and things. You see, let me make it easier for you to understand. There are some people doing the motorway overhead at the flower pot to East Legon. So let's say the contractor is Consa. I don't know the contractor, but I think it's a Chinese people. Let's say it's Consa. Now, Consa will go into a contract with the government of Ghana. All right. The contract is that they are building that overpass for year 1, year 2. Construction, it takes some time. Year 3, then year 4. So that is what they are doing. Overall, the contract that they've signed, revenue is 100,000 Ghana cedis. Now, Consa has bought some machines. So the cost he has incurred to date is 50,000. But he estimates that he will estimated cost to complete, apart from the cost to date, is 30,000, which means that overall, the job that they are doing, they will get a profit of how much? 20,000. How many years is this profit for? Yes, how many years is it for?
4 years.
4 years. That's the entire profit for the 4 years. But you see, if you are an accountant in this construction company, you prepare P&L how many years? Is it not year on year? Right?
Yes, sir.
Yeah, you cannot prepare 4-year P&L at once. So step 2 is, so you will need to prepare P&L for the year on year. How do you now record the P&L year on year? The step 2, therefore, is to find the progress. So because you use the progress, don't forget we said that you recognize revenue when you have done what? Performed the obligation. So it is the progress. How much have you done in the 4 year? So 4 year is 100%. How much percentage have you done? It is based on the percentage you have done that can help you recognize the revenue for specific period. So, but the thing is that assuming this thing was a loss, it means that as for loss, recognize the loss completely or immediately in your balance sheet as a liability. You call it a one-loss contract. A contract when you have not finished, you already know that you make a loss. Immediately, debit your P&L with the loss and credit your liability immediately. All right. So step 2 is to determine progress. There are 2 ways of determining progress. Those of you who did cost accounting in senior high school, may carry all those things. So you can use the input method. We were doing those things without understanding. It was when I was doing ICI. Okay, so then I so fast one. You use the input method or the output method. Input method is cost-based. So how do you do that? You want progress percentage. So you will use what? The cost to date over what? Total cost. What is the total cost in this question? And what is the cost to date in this question? If you are using the cost as to determine progress, what do you think our answers will be? What is the cost to date? 50, right?
50,000, yeah.
What is the total cost?
80,000.
80,000. So these are the total costs. Now, what will be the percentage for that?
62.5.
62.5%. All right, it's always in percentage. All right. Now, if you want to use the output method, then the examiner needs to give you what we call work certified. You see, those of you who know how construction works, my brother is in one of them, and I happen to also be the accountant for my brother. Now, whenever they want to collect money from the government, they need to provide a certificate called work certified certificate. And it is based on that the government will look on to give them money, because government doesn't pay the revenue at once. And in a contract, they don't get the money at once. Into the work certified certificate in the court now buying money scanner, no so. So now the output method, you need work certified. Now, if the work certified is they've done 80,000, the formula for output method is work certified over total revenue. That's the output method. So what do you think the answer will be here? So we have work certified, which is 80,000. Total revenue is how much?
20.
100,000.
100,000. It's not 20. 20 is the profit. So this one will be what? 80%. So that is how you get progress percentage. Now, once you have progress percentage, so that is what I've explained here. Step 3 is to now calculate the P&L for 1 year. The P&L. You can only do a P&L if the project is profitable. If the project is not profitable, then the loss that you made is the loss. I mean, there is nothing P&L about it. You only do P&L when the thing is a profit making. So that is that. Now, step 3, P&L. How do you get the revenue for the year? I'm going to ask you some interesting questions. Now, let's go back to our chart. This chart that I drew. Then, the year 1, the person completes, let's say, let me use like 50% of, and here by year 2, he has done 70%, year 3, he has done 90%, then year 4 is the 100%. How much revenue can you record for year 1? How much revenue? The revenue for the entire 4 years is how much?
100,000.
So how much do you think you can record for the first year?
50,000.
50,000.
I like your vim. How much revenue can we record for the second year?
20,000.
20,000. I like that. Why 20,000? So OBP says 70,000. Wow, one kind of crack. But I see the truth is, if you put 70,000 here, haven't you exceeded the entire 120 already?
You have.
Yeah.
And one of the more exams, no. Now, so you do the 70% of this, it will give you 70,000. But don't forget, your year 1 took 50 of it already. So it will be 20,000. Okay, what would be the revenue for year 3?
20,000.
20,000.
20,000. I like this. You people are good. You know why I'm laughing? I've done this thing over years. People get it wrong all the time.
Year
And
4, 10,000.
Year 4 is a the
10,000.
revenue for year 4. Good. It's 10,000.
10,000.
And then you move down. So that the total is what? 100.
100,000.
What about the cost? The cost. If you want the cost for the first year, how much will it be?
The cost will be
40,000 for first year.
How did you get
No.
the 40,000 first year?
That's 50% of the 80,000 total cost.
So 40. Second year will be how much?
15,000.
So you did 70% and deducted the 40, right?
Yes.
Yeah, so 15,000. So that is how you do it, okay? So to be able to do the P&L, and that is what I've done here. So depending on the year you are doing the thing for, you do the revenue, which is the percentage, progress percentage that you have calculated for, all right? Multiply by the total price, which is the contract price. Then you less what? Revenue recognized in previous years. So that is what you've done here. I decided not to come here first, but I use this illustration. Once you now understood it, the rest is theory. I just developed it into formula for you. So the cost of sales to the same thing, the cost of sales, then you less cost of sales recognized for previous years. Then you can now get the profit for that one particular year. All right, so that is that. Then step 4, which is the last step. Step 4 is to do the balance sheet. So your SOFP, you will need the cost to date. All right, you need the cost to date. This is the actual cost, not necessarily the cost of. And the cost to date in this question that we just did is 50,000, right?
Say the year 2. Sorry for dragging you back. Year 2, is it 15 or 16?
Well,
16.
it's 16, eh?
It's 16.
All right, 16. Because you do 70% of the 80, right?
Yeah, minus. It's 16.
All right. Minus the 50, now 40, now I'm 16. Yeah, it's 16. I just thank God you are following and you are understanding it. All right. Then, so you need a cost to date. In this example that we are doing, our cost to date is actually 50,000. So you put it down. Then you bring in the profit recognized today. So recognize profit today. So depending on the year we are preparing the account for, you see, when it comes to the profit date, it is not 1 year. Profit to date means what? Like profit you've been getting up to now. So it's kind of what we call the retained earnings, right? So if it were to be year 3 here in this question, and a higher 90%, what will be our profit to date? Look at
90,000.
it. What?
90,000.
The profit to date.
Okay.
Will it be 90,000? It's profit to date. So the cost, the revenue would have been how much? 90,000, right? And the cost,
it would be like 14,000, yeah.
And the cost would have been how much? 90% of 80.
That is 72,000.
So somebody mentioned it right now. He said it will be how much? 18,000. So the profit to date will be 18,000. That's how you find profit to date. So profit to date, 18,000. If the contract was a loss, you would have recognized the loss completely. All right. But this one, there's no loss. So loss will be dash. Then you will less receivables. What is a receivable? The money that you have taken or the invoice that you have billed to the government of Ghana. So you will take that one, amount billed. You take that one to out. You take that one to out. Now, once you take that one out, this question, there is no amount billed. So it's like to be like this. So you get 68,000. This 68,000, if it is a positive figure, it's a contract asset. So you add it to your current assets. All right. If it is a negative figure, it is called contract liability. So you add it to your what? Current liability. Now, if there is any PPE that you have bought, you see, if you bought a plant in this construction contract, you will add the plant as part of your cost to date. But you see, after the contract, you see the company will still be having the plant. Is that not it?
Yes, sir.
Yes. So therefore, if that thing happened, then the asset, the carrying amount of that plant, all right, will now be standing in your books as a PPE, separate from the construction contract, because after the contract, you had a plant. So you recognize the plant too as the carrying amount of the plant as part of your PPE. Please, is that understood? All right. So, ladies and gentlemen.
Hello,
yes.
Sir Tom.
Yes, sir.
Oh, please, with regards to
the plant.
Yes, with regards to the plants. For instance, maybe the useful life of the plant is maybe 10 years, but the contract is what you did 4 years. So how are you going to charge the depreciation?
Oh, you charge depreciation. The question will give you you said, okay, let's guess an amount for the plant, right? So let's say in between this cost, the cost to date, there was a plant of, let's say, 20,000. All right. 20,000 plants. And you said the useful life is 10 years, right?
Yes.
So if useful life is 10 years, so this is what I've done here. If useful life is 10 years, then it means that 4 years depreciation will be how much?
4,000.
Is it 4,000? 4 years.
4,000. 4,000. So a year will be 2,000.
A year will be 2,000. So 4 years is how much?
8,000.
So 4 years is a year is 2,000. So 4
Yeah,
years
so
is
4 years, 8,000.
2,000. So that is his question. So this depreciation, the depreciation will start to what? The statement of profit or loss, according to what? The progress made in satisfying the contract. Now, aside that, your question is that, and I'm telling you that the carrying amount in this case, which is 12,000, will now be standing as a PPE after the project is over. So you continue with the depreciation of that. Are you getting it? In your balance, in your P&L? Yeah. So the remaining 6 years, you continue depreciating it in your P&L.
Okay.
Yeah.
Thank you.
So that is that. All right. Now the specific thing you need to know is something we call repurchase agreement. And this repurchase agreement is something you need to be careful of. If I sell an asset to you, let's say I am A, I sell an asset to B. All right. Then I repurchase the asset again. It means that technically the asset is still with me. I sell to you and I've repurchased it. So a repurchase, sell and repurchase asset, we said that the economic substance is more likely to be that a loan, the money that you took is a loan against the asset that is never actually been sold. So we are saying that if you sell and repurchase, it means that you actually didn't sell. You actually didn't sell. So when a vendor sells an asset to a customer and either acquired it or has an option to repurchase it, so it's either you buy it back or you have an option to repurchase back. The legal form here is always a sale followed by a purchase at a later date. The economic substance is that you never sold the thing, because at the end of the day, the thing will come back to you. So it never left you. So you didn't actually sell it, and therefore the money that you take is a loan. Please, have you gotten it?
So meaning you can't recognize revenue.
Exactly. Because it's a sell and repurchase. The economic substance is that you never sold it. How can you sell something that is still with you, or you still have the option to get it back? So that is a specific. So you treat the thing as a loan, like the way we did on the loan. Example 9. All right. Number 2, specific issue number 2. Let me ask you this question. If you have a contract like we are doing, so the contract, and the contract that you are doing, you realize that your contract area, you make a loss of 50,000. You make a loss of 50,000. It is called one-loss contract, a contract that you already know that you make a loss even before you finish it. It's called one-loss contract. And I told you that in step 1, if there is a loss, what do? You recognize the loss immediately as a liability. Now, let me ask you a question. If you have a contract, when you finish, you make a loss of 50,000. But since you know you make a loss, you breach the contract and incur a penalty of 40,000. What will you do? What will you do? Yes, what will you do?
Please come again.
If you have a contract that when you finish, you make a loss of 50,000. But when you breach the contract, which means you won't do the contract again, but because you've breached the contract, you will be paying a penalty of 40,000. What will you do?
You breach the contract to pay less.
You breach it. So each time there is a one-loss contract, find out if there is a breach penalty. So you provide for the lower of the loss or the penalty for breaching. In Ghana, these are the situations we have in Ghana. The contract loss will be 40,000. but the penalty for breaching it is 50,000. So abandoning him say adena because when they breach it, they will be paying a higher money. So they will continue to do it and incur the loss. Most of the government contracts that are happening is at a loss.
Oh, yes.
Yes. But when they breach it, the money that they will probably pay is higher than the loss. So they will continue to do it to make the loss. That is where we find ourselves. So in that case, you provide for the lower, all right? Build and hold. But I sell it, but I keep retain now of the possession of the thing. Please, that one, sales has not happened unless the thing is being transferred. Take note of that. Take note of that. Then the last bit is consignment. You know, a consignment will be clear on your free port mawa. Sale has not happened until the thing comes to your house, your storage or your house. You know that. If the person import the thing, it has to come to your house. I say we import to car. We import to car, so car number of years. So how can you say we import to car? All right. So you can never recognize it unless the ownership is transferred to the owner. So, ladies and gentlemen, this is IFRS 15. All right. That's IFRS 15. Now, all the examples that you have here, which we won't have the time to go through, is the contract. Fish out. Let me trick you. Let me give you 5 minutes. I want to see something. If you guys can do this question one. Just that question one. Just that one. Per what we've done. The stages of the things that we've done. Here, you are supposed to do it up to only the P&L. There is no balance sheet in it. Let me see if you can do that. Try.
Sir, the owners contract, what was the explanation you gave?
A owners contract for which you know that you make a loss even at the beginning or in the middle of it.
Okay.
So that's that. So you always provide for it because you have a present obligation of a loss. All right. Now, so solve the question one, everyone. I'm giving you 5 minutes. Now, we actually need the overall P&L, right? Step one.
Yes.
And this question, we won't do the SOFP because we are supposed to be ending it at the P&L, the P&L for the year. So the contract commenced 2014. It says that a 3-year contract, sorry. Building contract during the year 31st December 2014 and continue the contract in 2015. And we have the details. So the overall, what is the contract value?
45 million.
Yeah, so contract value is 45. The costs. So we have cost to date.
Cost to date, 20 million.
Estimated cost to complete.
12 million.
So what is the overall profit?
13 million.
Did everybody get that?
Yes, sir.
All right. Step 2 is progress. We are preparing this thing as at 31st December 2015. Don't forget. So the progress as at 31st December 2015 is what percentage? Stage of complete. 70. Don't forget the project started in 2014, you know, and we are supposed to do the P&L for 2015. So do you remember how we used to do it, where we deducted the previous year? You remember?
Yes.
Now watch this. And this is where the trick is, and I know most of you would have been beaten. Yes, Maxwell.
Call to complain. Is it your fault?
It's what?
Is it true or job?
I can't hear you. It's 12. But this is it. It's in the question. Or
Yeah, because of the other you have the 45 minus 2 minus 2.
Oh, we are picking the figures from the question. So that is where it's from. Now, so so watch this. The estimated, you see, the progress is 70%. But did you read this English very well? Work certified as complete. The word, this preposition in 2015,
Yes.
what does it mean? What does it mean?
Meaning that's the work they did in 2015, the actual work they did.
How different from, why is it different from the one that we did before, the examples that we have been doing before?
I think it's output method.
No, it's not about the method.
I think that one was progressive.
Exactly. So
Yeah.
they use the word in. You see, the one that we've been doing, you remember, is work certified to date. So that one was work certified as at. Do you see the difference?
Yes.
So please, English is very important. All right. So it tells you that the revenue for 2015 will be how much? To be 15. You won't less any previous year. Please, do you understand? Because of that word, in 2015. So I know that is where most of you might have fallen short.
Yes, I got it wrong there.
Somebody did 70% on the on the total cost. Yeah. So, and you know, these are things they do against you in the exam. So, and anytime I see the examiner has brought one trick in a simple question, and I know how students actually there's something you see, you people don't pay attention to details. That's the truth. It's like, yeah, class is here. You see, yeah, class. Most will be the about to WhatsApp page. So, please, is the class going on? Meanwhile, the link is there. I'll be say, yeah, the class is going on, and I say, what are there too? Please, have you closed the class? Okay, so be my answer. Oh, now me person me join you no more close to class. I mean, you could have just clicked on the link. You are there. So please, paying attention to detail is part. It's a very important thing you guys should adapt, learn. So now that you have that, and you see the profit that you have, you see they gave you profit recognized as at 2014. Have you seen that?
Yes, sir.
So if the work as at 2015 is so we will always need our cost and we will need the profit.
Hello, sir.
Yes, please.
So assuming I don't know this technique, then I go by calculating the work certified, using the work certified over the.
Let's do that. Let me show you.
Total revenue.
Don't worry.
To get the percentage and multiply.
Don't worry. Let's do that. So when you did 70% of 45, what did you get?
31.5.
31.5.
So 31.5. Where will you get the previous year's revenue to deduct in this question?
3.3.
That is not the previous year's revenue. That is profit.
That's profit.
Yes.
Wow.
Wow.
So and be careful sometimes, all right? Be careful. Just be careful. But because the work certified up to this point is 70%, we can actually get the profit. Profit for the entire project is 13. So we can actually get the profit for that particular year. So that will be 70. Profit on this will be how much? 70% of this will be how much?
9.1.
9.1.
9.1, yeah.
9.1. That is the profit to date. Now, for the profit, you are giving the previous year one, so you can deduct. How much is the previous year one?
3.3.
3.3. So what is your profit to date? What will be the profit for the year? Sorry, that particular year.
5.8.
5.8. And if you have the 5.8 for that profit, what will be your cost? What do you think your cost is? So the cost is a balancing figure. You need to look out for
9.2.
9.2. I made you do this question because it doesn't follow the normal pattern. And
It's tricky.
It's
Sir.
tricky. Exactly. Yes, please.
I also got 5.8, but I don't know
Different
if
approach.
yeah, but
Which approach did you use?
the
Enlighten us.
70% of the 45
Which you had this.
minus the profit.
Hey, what for profit is here for revenue? Okay.
Then
I don't need
I
you be
found
to me balancing, but you're balancing behind the parcel.
70% of the cost.
70% of the cost. The cost was 32, right?
32.
So 70% of the cost, every month. Put you away from when you're there. And 70% of the cost is here.
22.4.
I had 22.4. Is it this one or the cost?
The cost.
The cost is 22.4.
Yes, sir.
Now, how much I was saying?
And no, mommy, 28.2.
2. And I'll take free Mununya of 5.8.
Yes, sir.
A criminal. Hey, we're by force balancing.
That's all.
That's all there, that's all. But you see, the cost that you gave me, the cost that you gave me, this cost is 2015 cost. How come you didn't deduct previous year's own cost from the thing? It's a criminology now. I had a student in financial reporting. The day she wrote FR for the first time, came to me and said, "Thank you. Hey, me balance consult. We balance publication. Ratios, Oh, standards, Study your trend is how we have me. Then the exams came 5, results came no 50. I say, hey, say now more exams no say na sifate. The way I'm feel me balance here, I didn't pan. Me expect 80. Me try 50. I'm saying, oh, as for the balancing, anybody can balance the account. But to how you balance it, if it is correct, yeah. All right. So, that is why you go back. The second question too is like that. I want you guys to look at it. But apart from these two questions, the other ones follow the normal call. This one is the one that you PV the revenue thing that we did. All right. So that is that. So please, see, this is what I want to encourage you guys to do. So today, for example, we were able to do. Please don't be burdened that we spend time on the revenue, because I had to explain it to you because of what I believe is coming. So I've taken time to explain all the facets of revenue. Your job is to actually go through the questions. I've given you plenty questions. Some of them are all the ICA pass questions from level 1 to level 3 are there. And I myself have added additional questions. So all these questions that you see are questions that I have added for you. Then you see the FR part I've added. Your own corporate reporting pass question for you to practice. I've added it in your manual. And this question is what I tip. You see, let me advise you. Where I pick my questions from to do the book, I picked a question and I realized that IC has already used the question already, and they changed the name, Keke, and they changed the currency. I was laughing. So I've added some questions from that same area, and this one is one of them. Carson is one of them, and it is 7 marks. So be careful. Solve it. I've also added another one, crypto. This one. So untumi nye krano, please attempt Carson. Untumi nye. O the one nye question beyond. Do Carson. Do Carson. All right. So, ladies and gentlemen, I'll end it here. But you see, like I was saying, we will meet again next week. But I think next week Saturday I have a wedding, so but we'll meet. And I wanted to okay. So thank you for joining this class. Let me end this class for now on this note.